Hi, this is Jeremy Kellett, Director of Recruiting here at Oakley Trucking. I'm your host for this podcast. This is episode 98. You know, this podcast was created to help Oakley owner-operators and their families be more informed about what's going on at Oakley Trucking. So we can communicate better with you so you'll be more successful. And guess what? If you're more successful, Oakley Trucking is more successful. So we created this podcast, and we hope it helps all Oakley owner-operators do better in their job and learn things every week that we do it. So I'm joined today by Jeff Amon and Michael Schneider of ATBS, a tax accounting firm for truck drivers, and they're going to answer some questions that our owner-operators have been asking. We're also going to discuss the benefits of ATBS as your tax service. So we offer ATBS here at Oakley Trucking as a settlement deduct for our owner-operators, and it's a great service that we offer for them. And I always like to get these guys on, try to do it every year, and they were gracious enough to do it last year and kind of get the old podcast kicked off too. Helped us a whole lot. But I tell you, you can get even I know things have changed, but they did episode 47 if you want to go back and watch that one. Last year, that was a really good episode and asked a lot of questions. But this one right here is going to be even better because I actually sent out an email to our owner-operators seeing if they had any questions and to shoot them back to me, and they did. I was overwhelmed because I only did it yesterday, so in less than 24 hours, they've shot me back a lot of questions, which I'm going to hit you guys with. So I appreciate you guys joining me and doing this podcast and helping our owner-operators, know more about taxes, because it's a thing that can be very confusing when it comes to being an independent contractor. And if you guys will, I'll let you start on your end, maybe introducing yourselves and ATBS, and then we want to dive right into some of these questions. And I know I sent you some, and you guys sent me some too, and hey, if we don't get through all of them, that's fine with me, but we can get to some of them and what you think also is important to communicate to the truck drivers right now.
That sounds great, Jeremy. Thanks for having us on the podcast. We love it. We love the opportunity and appreciate it. I'm Jeff Amon. Beside me is Michael Schneider, as you said. Michael runs our tax department at ATBS. And I'll give you a quick background on ATBS. So I've got two brothers, and the three of us own ATBS. My two brothers and I, we started in trucking when we were 12 years old as diesel mechanics, and we spent our entire lives in trucking. By the time, like I said, we started when we were 12 as diesel mechanics. By the time we got out of college, we had done just about every job you can do in trucking. And after college, we owned our own trucking companies. We had an LTL company with about 150 trucks. We had a truckload operation with about 600 trucks. And we had a logistics and brokerage operations. And, you said something right at the beginning, Jeremy, that you do these podcasts to try and help your independent contractors be more successful, because the more successful they are, the more successful Oakley is. And that insight is unbelievable. And it's something a lot of people don't understand about owner-operators. And so I can tell you the reason ATBS exists is because of that exact comment you made. And I'll elaborate on that a little bit. When we owned our trucking companies, my two brothers and I, we came into work one day, and we sat around a conference table and looked at each other, and we said, this place sucks. Our employees hate us, and we hate them. Our truck drivers hate us, and we hate them. It's no fun to come to work. The culture is awful. And we looked at each other and said, why is the culture like this? Why do we hate all our drivers? Why do all of our drivers hate us? And what we came to the realization of is that at that time, we were 100% company drivers, no owner-operators. You guys are 100% owner-operator, right, Jeremy?
Yes.
Yeah. I wanted to double check that. I knew that was the case, but I wanted to double check before I make these comments, because it'll piss off some company drivers. But here's the deal: when we were looking around the table and said, "Why is our culture so bad?" and why do we have this awful relationship with our drivers? This is the deal. In trucking, the market sets the rates. There's the largest trucking companies in the world control less than 1% of the marketplace. So, you can't, as an individual trucking company, we couldn't go out and charge more for what we did, because there's 1,000 companies behind us that would do it for a lower rate. So if the market is setting the rates and we can't charge more for what we do than anybody else is charging, then for us to generate more profit, which every owner of a business wants to generate as much profit as possible, if you can't generate more profit by generating more top line revenue, then the only way to generate more profit is to cut your costs. And when you've got employee drivers, your single biggest cost is labor. And so the biggest opportunity to cut costs is to reduce your labor costs. That's your truck drivers. And so for us as owners to make more money, we had to figure out how to make our people work harder and how to pay them less for what they did. And so it was a win-lose for us as owners to make more money. Like I said, we had to figure out how to make everybody work harder and how to pay them less for the work they did. And so it was this awful negative culture. And we said, how are we going to change the culture in our business? And for us, it came down to owner-operator. We started effectively the first lease purchase program in the country and turned our employees into owner-operators. We passed everything on at our cost. There were no markups for anything. And our employee drivers became owner-operators. And it completely changed the culture of our company because, as you know, and as you stated, with owner-operators, essentially the company is getting a percentage of their take. And so the more successful your owner-operators are, the more money they make, the more money you make. And so your mentality goes from, your culture goes from beating people up to lifting people up. It's a win-win. Right. The more successful the owner-operators are, the more successful the company is. And so literally, we converted our fleet to 100% owner-operators, changed the culture of the business. Our owner-operators were killing it. And eventually we had an opportunity to sell our trucking companies to carriers that wanted our model for running owner-operators. And we sold them, and literally the day we sold our last trucking company, we started ATBS, the exact same day we sold our last trucking company. So ATBS's sole reason for being is to help our owner-operator clients make as much money as they can possibly make and to give as absolutely little of that money as possible to the IRS. Minimize their tax burden, keep it in their pocket, help them be successful. So, I mean, that's the down and dirty. I could spend hours telling that story, but right. That's the down and dirty of who ATBS is, what our background is. And I guess the way I would describe ATBS to anybody listening is our goal is to be the back office for our independent contractor clients, our owner-operator clients. They drive the truck and maximize what they're doing, running their business, and we're the back office managing everything. You know, I always say no owner-operator became an owner-operator because they had this burning desire to do their own bookkeeping and taxes, right? That's the necessary evil that goes along with owning your own business, is having to do all of your bookkeeping, accounting, and tax work. So for us, our business is about taking that burden off of our clients' shoulders and doing all that work for them so they can do what they truly love doing, which is driving those trucks.
How many clients do y'all have, Jeff?
Boy, you know, that's an unbelievable question, and I can't even give you an exact number. And all the things we do, we work with over 75,000 owner-operator clients. And wow. Yeah, it's a huge number. And a statistic that I think is unbelievable, a couple statistics. We bring on average for the last year, we bring on a little over 1,000 new clients, new owner-operators a month join our service. Which is a huge number, 1,000 new owner-operators a month coming on board. And even with, like last month, I just looked at on Monday, last month we brought on 1,070-something new clients. Even with 1,000 new clients joining our service a month, our average client has been with ATBS for almost 4 years. So even with that many new clients, our average has still been with us for nearly 4 years, which we're really proud of that.
Well, you should be. That's an amazing number. I would have no idea that many will be coming on every month. That's a load for you guys. Michael's going to have to do a little OT.
This time of year, man, Michael's department is overwhelmed. A lot of tax work. It's incredible. I'll tell you a couple other things that I think are amazing. One is specifically to Oakley. So when people benchmark ATBS clients versus owner-operators that don't use ATBS, our average client earns 40% higher profit than an owner-operator that doesn't use ATBS. I think I mentioned that earlier, and they pay thousands less in taxes. But here's something I just looked up literally minutes before walking into this room. We have the largest database in the world on owner-operator performance across the country. Our average owner-operator last year, Jeremy, made $71,000. Like I said, we're going through these numbers right now. We publish big statistics for the entire industry. Our average owner operator made $71,000 last year. Here's the statistic that's unbelievable. Our average Oakley client last year, guess what they made?
Tell me.
Yeah, $120,000.
Cha-ching.
$50,000 more than the industry, than our average client. Our Oakley
Wow.
made 120. Is that unbelievable?
That's unbelievable, and that's good information for our guys to hear, because right now that carrot's out there, dangling of money here, money there. Y'all come over here, so it's real tempting for guys to chase that dollar right now when it's really it's not as good as it looks sometimes. And if you just stay at home, you can reap the benefits at Oakley. So let's take a quick break and hear from our sponsor, Aero Truck Sales. Keith Wilson at Aero Truck Sales in Springfield, Missouri is currently offering $1,000 off your first month's payment when you finance with transport funding, or $1,000 off the truck price if you bring your own financing. They're also discounting the cost of an extended warranty by $500. Aero Truck Sales has been a long-time partner with Oakley Trucking, and that's because they specialize in first-time truck buyers. They don't do any leases. They have the best used trucks money can buy, because used trucks is all they do. They don't sell any new trucks. And the biggest reason that Aero and Oakley are partners is service after the sale. It is very important to us at Oakley that when we refer you to a company, that they are a good company with good people. They do what they say, and they understand our requirements. So give Keith a call at 573-216-6047 for a good used truck, and tell him you heard about it on the Oakley Podcast. Let's get into some of these questions from our listeners that we can knock out pretty quick if you don't care. One is, I think, let's see, I had, thank you, Adam, kept coming up that I know can be a whole podcast in itself, but y'all try to do your best to limit the simplest way of being a sole proprietor versus being an LLC or incorporated, and maybe a couple of pros and cons for our listeners.
Yeah, so again, I'm Jeff, and I'm doing a lot of talking right now, but Michael's the one that knows all this stuff inside.
That's it.
I answer the easy stuff, and Michael, when it gets tough, Michael's the one that has all the answers. I'll just tell you from my perspective, sole proprietor versus S corp, LLC, those things. And so, first off, let me just say we're an accounting and tax company, so legally we're not allowed to give legal advice. But I can give personal advice and say that all the companies I own several businesses, they're all LLCs. And the reason I like LLCs is because they have the legal protection of a corporation. So that's one of the first and primary benefits of being an LLC or an S corp is legal protection, because you as an individual are separate from your business. But beyond that, I think taxes are probably the single most significant issue in determining whether or not to be a sole proprietor. And so I'm going to describe, like I said, I get in the weeds, and it would take, as you said, a day or two to get through all this. I'm going to describe at a very high level the difference between a sole proprietor and an S corp. So as a sole proprietor, when it comes to taxes, essentially you pay self-employment tax on all of the profit of your business. Like I said, Mike will get in the weeds and get into really specifics. I'm going to stay big picture. Just think of it as a sole proprietor. You pay self-employment tax on all the profit of your business. If you're a sub-S corporation, we turn you into an employee of your corporation. And once you're an employee of your corporation, you're only paying FICA tax on the salary you pay yourself out of your business. So instead of paying self-employment tax on all the profit of the company, you're only paying FICA tax on the salary you pay yourself. Like I said, it's a little more complex than that, but that's really the tax consequences. And so when I think of that, when we analyze our clients, we see somewhere around $68,000 to $70,000 net income or higher. We can save you a whole bunch of money on taxes by filing your taxes as an S corp. Because again, instead of paying self-employment tax on all the profit, you're only paying FICA tax on the salary you pay yourself. And by the way, we'll do all this. Well, go ahead. You got a question, Jeremy?
So, yeah, real quick. So on that, so you just pay taxes on what you pay yourself if you're an S corp. Well, what about the remainder of the money? So I made $150,000 or $120,000, and I paid myself $75,000. that other 75 that's in the S corp, how's that taxed?
The profits of the business are essentially taxed the same, whether you're a sole proprietor or an S corp. You've got to pay income tax on the profit you make, and so just because you pay yourself a salary out of your business, you pay FICA tax on that, but you're still paying net income tax. You're paying income tax on the profit of the business in both scenarios. So there's not a big difference in the income tax. The difference is in that self-employment versus FICA tax. And again, instead of self-employment being on all the profit of the business, the equivalent of self-employment FICA in the self-employment in the corporation, you're only paying FICA tax on the salary. Now, there's a couple things about that I should say. First off, it's a lot more work to do taxes as an S corp. Like I said, we make you an employee of your corporation. Let me say first off, we can do all this work for you. We do all this work for our clients.
Oh, okay. That's what I was going to ask. Y'all take care of all that.
We'll do your payroll. We'll file your payroll taxes with the Secretary of State. We'll keep your corporation current. So we do all of that. And then you have to do corporate tax returns in addition to your personal tax returns. We'll do your corporate returns. We'll do your personal return. We'll do all that. It's going to cost you a little more money because we have to do all that extra work. And so we always do the analysis, and it's always the client's choice. We do the analysis and say, if we file your taxes in S corp, here's how much we can save you. Here's how much more it'll cost you. The net difference, we'll save you $5,000 or $8,000 or $10,000 or $20,000, whatever the number is. Here's how much we can save you. Do you want us to do it this way? And it's always the client's choice. But again, we do all the work. They don't have to do extra work. We'll do the work for them. The second thing I'll say is people ask us all the time, should I be a sole proprietor? Should I be an LLC? Should I be an S corp? Should I be a C corp? First thing I would say is do not be a C corp, period. And if somebody's talked you into that, call us so we can unwind it immediately. And that's because essentially a C corp has what's called double taxation. You pay all the taxes on the business, and then when you distribute the money to yourself, you pay all the taxes again on everything you distribute to yourself. So double taxation in C corp is awful. One reason to be a C corp is if you plan on going public. Otherwise, is that you? Yep. Otherwise, it doesn't make sense. S corp is the kind of taxes I think makes the most sense. But I can just tell you personally, we recommend 95% of the time to be an LLC and not an S corp. And the reason is, if you become an LLC now, as an LLC, you can elect whether to. So as I mentioned before, an LLC gives you legal protection, like as if you're an S corp. But as an LLC, you can elect to file your taxes either as a sole proprietor or as an S corp. So you have the choice as an LLC how to file your taxes. And so if you're an LLC and we say we can save you a bunch of money by filing your taxes as an S corp, do you want to do it? And you say yes. All we do is elect with your LLC to file taxes as an S corp instead of as a sole proprietor. So LLC is kind of the best of both worlds. You can be an LLC and elect to file taxes either as a sole proprietor or as an S corp.
Good info, man. That's good stuff. I didn't realize y'all did all that too. So that makes it a one-stop shop for everybody.
We do. So maybe to add to that, just when you say you didn't realize you do all that stuff, we work with clients with 20 or less trucks. We've got one client that has 21 trucks, I think. But in general, 20 or less trucks, we can handle everything for them, do their payroll for all their owner-operators, or for all their drivers. If they've got drivers or owner-operators running for them, we do their 1099s. We do all of that.
Man, that is good to know, because occasionally we've run into that in this past week, a guy wanting to drive for somebody, and he didn't know how to pay him. So we can refer him to you.
Absolutely.
Okay. Good stuff. That sounds good. Looks like they can always get in touch with you, find out more information on all these questions, which, of course, they can. Everybody can go to atbs.com and check all this stuff out. But let's get into some more of this. What about I had one ask about Allison asked, do they need a copy of their logs to prove this per diem? And then go ahead and tell us about the per diem changes.
Yeah, so Allison's talking about the per diem, and the IRS will commonly go to the e-logs as they are now. They used to be paper logs, but now they're e-logs. They'll go to that for proof of your per diem days. So ideally, yes, you want to have your e-logs as often as possible. Is it the end-all, be-all, the Bible of the tax deduction? No. So let's say you lost your logs, you didn't get your logs, whatever the case may be. There's lots of other ways to prove that you're away from home. So you can use your settlements, you can use your travel miles. They took a load all over the country. Obviously, you're away from home. So there's other ways to prove that than your logs. But yeah, if you're going to use the ace up your sleeve, it's your logbooks. If you don't have the ace, use the king. That's your settlement. Go on down the list and prove it the best way you can. So that's what IRS is going to go after. You mentioned per diem changes. There are a couple that we want to go over. So the rate went up this last year. Most drivers probably know that by now. That change was October 1st of 2021. The rate went from $66 a day to $69 a day. So definitely want to keep your logs, keep your per diem records, and make sure your tax accountant is taking care of those for you. The bigger and more significant change this year is the restaurant 100% meal deduction rule that is in place for 2021 and 2022. So what the IRS came out and said, and we did a lot of research on this. I actually called the author of the tax code to ask them these questions about truckers, because just as kind of tax law is written in general, they didn't keep truckers in mind when they did it. So I called them up and I said, hey, what about per diem? They said, well, we haven't thought about that. So we talked through it, made a decision. They came back 6 months later and IRS announced that the per diem is 100% deductible for 2021 and 2022. So that is huge. If your old tax preparer is trying to use 80%, that is incorrect for 2021 and 2022. So that's going to be huge for drivers to take 100% per diem deduction. And we were kind of on the forefront of arguing with the IRS and fighting about that. So that was interesting to talk with those agents over there that write the code. But
Michael's not giving himself enough credit. I can tell you that. So this was part of the last stimulus bill, and they, through stimulus, Congress decided they wanted to stimulate restaurants to be successful, try and bring them back and save them. And so for that, they said business meal deduction is going to be 100%. And that's great, for you and me, Jeremy. If we go out to lunch, we can deduct 100% of it. But for our truck driver clients, a business meal deduction is irrelevant because they're taking per diem. They're not deducting individual meals. And so, like Michael said, he went directly to the counsel of the IRS and said, hey, our truck driver clients are getting screwed over because they take per diem. They don't take a business meal deduction. And he spent a lot of time working with the IRS, and we made the decision that per diem was 100% deductible. And like Michael said, after working with chief counsel of the IRS, they came out and 6 months later and announced that they were formalizing what Michael had worked out with them.
And that's for last year and this year.
Yep.
Correct. Yep. So taxes you're doing right now for last year and next year's taxes. Yep.
That can be a significant amount of money.
Absolutely.
It is a significant amount of money. And the other thing Michael mentioned, I just want to reiterate something, is the per diem rate change in October. Very few tax people out there are going to waste their time trying to figure out the new rate for the last quarter of last year. They're going to wait until 2022, and then they're going to take the new rate. We don't do it that way. The second the per diem rate changed, we changed it for our clients. So if you're not using ATBS, whoever you're using, make sure to educate them that this per diem rate changed in October, and I want credit for it last year, not just in 2022.
Yeah. Great information. So that's good. What about, I know I was looking at the next topic here of your notes, and you got home office. And explain what you mean by home office.
Yep. So home office, a couple of things to mention there. I want to start with the simplified method. This came out a few years back. It's been probably longer than that, but that's where my memory goes. So we've got $5 per square foot up to 300 square feet. That's called the simplified method, and you get $1,500 tax deduction on your return. If your office isn't 300 square feet, we'll measure whatever it is and take $5 per square foot for that office. So that is the best method to use. You're not going to complicate your taxes by doing a percentage of your utilities and your mortgage payment and your interest. You don't have to mess with all that math. $5 per square foot. The secondary thing that I like to talk with our drivers about is home office related. Is I'm in my truck, I'm not allowed to take a home office. IRS continues to remind us that even if your principal place of business is not your home, you can still take a home office deduction if you regularly and exclusively use a home office for your business. So that can be storage, that can be a place where you do your bookkeeping and accounting and tax work, whatever you keep your materials and work with your accountant to send that stuff. That's regular and exclusive use, and that can be a home office. Now, a couple things you want to watch out for. You don't want a bed in your home office. You want to be using a bedroom or a kitchen. You do want this place to look like an office, feel like an office, be exclusively used as an office.
That's a good point. Yeah, it's got to look the part that it's playing. I had another guy ask me kind of on that lines, John Haley. He said, what about if he uses his pickup at home? Is there any of that, mileage, gas, pickup? Can he claim any of that?
Absolutely. There's another great simplified method, and the IRS is moving a little bit this direction to simplify some of these things. But rather than taking your fuel, your maintenance, your insurance, and adding all that up and doing a percentage, there's another simple method to use. 2021 is 56 cents a mile. So that's what you get. Track your business miles, tell your accountant, multiply it by 56 cents a mile, and you're good to go. That's your tax deduction. This year, 2022, that's up to 58.5 cents. So we've all seen fuel increases, price increases, inflation, and whatnot. That is attributable. The IRS has recognized that and increased their rate from 56 cents to 58.5 cents. So track those every year, submit those to your accountant. That's absolutely a deduction.
And that's a great question, because that's one that so many accountants miss, one that so many drivers don't get taken advantage of. We specifically asked that question, and Jeremy, they don't think, a lot of drivers don't think in terms of, picture them or a spouse going to Walmart and they buy Windex they clean the windshield with and some other stuff for the house. Just because they bought some stuff for the house, as long as they did buy some for the truck, they can write off all the miles on that trip that they got groceries or whatever. So yeah, there's one thing I'll just say is that, and that's a perfect example, whether it's the personal miles in a vehicle, the miles on a personal vehicle, whether it's the home office deduction, where ATBS is, I mentioned we save our clients thousands of dollars in taxes. We are super aggressive on deductions. We do not cheat, period. Have never cheated, but we're aggressive on deductions. Michael and his team are working all day, every day with the IRS trying to figure out, we deduct things like sunglasses as a safety device, guard dogs. We don't care if you've got a Chihuahua on the truck. As long as that dog can bark and function as an alarm, we're going to take a guard dog deduction. You can write off vet bills. You can write off pet food. Just some of the unique things we do that very few people who don't understand owner-operators.
And so the person that is assigned to the driver, to educate him, they educate him on these different things. It's not up to him to find out all these rules. That's what he's paying you for, right?
That's exactly right. So what you're mentioning is every one of our clients has a personal business consultant that works with them. We give every client a list of all the types of things that they can be deducting, and then we're watching for stuff that they're not sending us. And if we're not getting certain types of expenses, we reach out to them and say, hey, you can be writing this stuff off. Send it to us so that we can take the deduction for you. And then at the end of the year, when we're doing their tax return, we literally, for our clients, every line item on a tax return, we estimate where they should be in terms of numbers. And if we see something where they fall outside that statistical bell curve or we think they should be, we reach out to them and we say, hey, we think your truck costs more than 4 cents a mile in maintenance. We're missing some maintenance expenses. Let's go get them so we can write them off. Or we think you're missing fuel from the third week of August. Let's go get it so we can write it off. And, a statistic that I think is unbelievable, Jeremy, is that, I arrogantly believe our clients are the most sophisticated owner-operators in the country. When we do taxes for our clients, every year for the 24 years we've been doing this, every year, 92% of our clients, we find stuff they forgot to send us, we go out and get it, and we take additional deductions. And what that means is, if they were going somewhere else to get their taxes done, 92% of our clients would be paying too much in taxes because this is stuff that somebody else, you go anywhere else, you hand them your stuff, they put in a computer program, they give you back a tax return.
Yeah.
You did all the work. We do all the work. We put it in, and then we look for what you might be missing. We reach out and say, hey, you've got a kid in college. We've been taking these kinds of deductions. Send us this stuff so we can write it off. As you said, we get in the weeds and we reach out and tell them what we're not getting that we could be taking for deductions. We don't just depend on them to send us what they think we can be deducting.
I had David Bird ask me about health insurance. Can you write off health insurance?
Absolutely. So this one can be a little tricky. So we'll dive into it as simply as we can. If you're single, meaning you're not married, and you don't have an employee W-2 job, you're just owner-operator full-time, absolutely yes. You can take your health insurance as the deduction. So what that means is the IRS is trying to push people toward employer plans, W-2 plans. So let's go to the married filing joint taxpayer. You're married, your spouse has a W-2 job, and they offer family health insurance. Your self-employed health insurance is not deductible because you chose to choose that plan over your spouse's employer plan. Even if it's a choice, you're not allowed to deduct it. But if your spouse does not have health insurance or wherever they work does not offer health insurance, then again, absolutely, your self-employed health insurance is a deduction. So that one's a little tricky when you're married, but yes, generally your self-employed health insurance is deductible.
Well, and that's that's a big obstacle for independent contractors because not a lot of them don't have a source to get health insurance, and I think this may help them knowing that it can be a write-off if they don't have a choice, and a lot of guys here, the wives stay at home and they don't have a job and they don't have that choice for health insurance, and so that's something good to know right there for sure.
Yep.
Let's see on the real quick. I had one ask about a cell phone line. You got 3 phones on your cell phone bill. How do you determine how much of that to deduct?
So I'm going to make this real easy for everybody. You're going to deduct the full thing. You're going to deduct the full thing. Yes.
All right, good answer.
IRS pivoted a long time ago, and this is what people forget. They get in their routine, they get in their rut, and they just keep preparing tax returns like they always have. And sometimes you got to be wary of those tax accountants, CPAs that have been doing it for 30 years because maybe they're doing it under the rules that were 30 years old. So the IRS in actually 2011 updated their guidance on cell phones from exclusive business use to primarily used for business purposes. So the way you and I define primarily, that's up to interpretation. I say 51% is primarily. So if you're using your cell phone primarily for business, you get to deduct the whole thing.
Okay, here's a good one. I had 2 people ask me this one. Anthony and Brent asked me about when you pay your taxes, does that include your Social Security? I guess, because they're wondering. I had one guy ask me, how do I know I'm paying in to Social Security? Isn't that when you pay your taxes?
Yep, absolutely. That's a great question. So kind of going back to Jeff's comments about an S corporation and being an employee, and I'll just say this generally. When you're an employee, your employer takes that for you out of your paycheck. They send it to the appropriate agency, and you're good to go. When you're self-employed, that's why people are so surprised when they owe more taxes than they think they should. You're paying the Social Security and Medicare at the end of the year when your tax return is filed. That's what the Social Security Medicare tax is. That's self-employment tax. So that's the 15.3% we talked to these guys about. You're paying your income tax at whatever bracket that's at, and you're paying this 15.3% self-employment tax. And you break that self-employment tax apart, what it actually is Social Security and Medicare.
Got it. I know they're going to get it some way or another. Just got to figure out. You know what my plan was, Jeff and Michael? My plan was I get to determine where my taxes go. So you give me a list, and I get to select. I want to put so much to military. I want to put so much to wherever. I get to choose where my taxes go. And isn't that a great idea?
I like your plan. When are you going to run for Congress?
I don't know. Never. Oh, man. Okay, let's see. Also on the new credits on I had 2 questions, or 2 people asked me the same question about the child tax credit from last year and how it affects next year. Can you elaborate on that?
That's a big one. I'm going to back up 1 second just to cover this before I forget it. The stimulus check was new this year. That was spring of 2021. That was the $1,400 check. So watch out for kids that were born in 2021. If you got anybody out there that had kids in 2021, they qualify for that $1,400 stimulus check. So make sure they're getting that. Moving on to that, you just talked about child tax credit. That has been enhanced by the current administration from $2,000 to $3,600 if you're under age 6. It's only $3,000 if you're between ages 6 and 17. So those are the two numbers to remember. Got kids under 6 years old, you're getting $3,600 this year for that child tax credit. If you've got kids between 6 and 17, you're getting $3,000 this year for each kid. So the complicated piece, of course, that's the simple part of it. The complicated piece is they started in July paying this out monthly, but they decided they're only going to pay half of the credit out for 2021. You're going to claim the other half when you file your tax return. So that's what these folks are asking about. The credit that was coming out July to December was a monthly credit. You might have been getting $300 a month. You might have been getting $250 a month. That depends on their kids' ages and how many kids you have. And then at the end of the year, when you go file that tax return, you're going to claim the difference. So you're going to tell the IRS, this is how much you gave me last year. I want to claim the difference and claim that, let's say, $1,800 or $1,500, whatever that may be for your family.
Okay, so remember, if you're listening to this podcast, you can rewind this and listen to that again, because I would have to back it up and just slow Michael down and listen to that again. But that is great. That's great information for our people to know, for our owner operators and all truck drivers out there to understand how that works. I mean, it's this tax thing can be confusing to a lot of people, and why in the world somebody wouldn't just pay you guys to do it, I have no idea, because it sounds like you've got it all together and understand it. So I would definitely look into that. Did we have a couple of other things? Let's see, that we wanted to hit.
There's another credit I want to touch on, and you might see me back and forth between deductions and credits. So deductions, they reduce your taxable income. Those are great. They're generally business deductions. Credits are an entirely new animal. Credits reduce your taxes dollar for dollar. They're fantastic. So the credits are the ones to go get if you can get them. So we're talking stimulus check is a credit. Child tax credit, that's a credit. Here's a third one for you, and that's the COVID sick and family leave credit. So this credit was passed, as you may know or may heard on the news, that if you were an employee and you got sick, right, your company had to pay you sick time. And all the people that were self-employed said, well, what about us? We're getting COVID out here too. We're having to care for family members that are getting COVID, and I'm missing work, but I'm self-employed. There is a credit available for you to claim on your tax return if that happened to you. So again, I'll cover those quickly. The first period is January 1 to March 31st. And that credit is a carryover from 2020. So we're going all the way back to 2020. If you had COVID and you claim this credit in 2020, you're done. You can't claim the January to March credit in 2021. However, they reset it as we had all these surges and COVID shutdowns and things we were going through again in 2021. They reset that on April 1st. So if you had COVID between April 1st or September 30th, that benefit, that credit is reset. So you can claim that credit again. And again, it's personal. If you miss time because you had COVID, you can claim 10 days, $511 per day. So you're talking about $5,110 credit on your tax return if you missed 10 days of work. Now that's based on how much you earn. So it's not 511 is the max. They're going to use your net income, what you earned, basic day you missed, right? They're going to use that calculation with a maximum of 511. The other one is you missed work because you had to care for a family member. So we're talking about spouse, kids, parents, people who live with you and you care for. If you miss work to take care of them because of COVID, that's up to 60 days and it's $200 a day. So you're talking about $12,000 credit potentially if you had to miss work for COVID.
How are they going to make us prove that, Michael?
That's a great question, and that's what Jeff talks about, being aggressive. Keep your notes, but they've got to come check us, right? If they want to take the time to come audit that, then they're going to have to figure out what they want to audit. But this is a self-attestation, if you will. I know that's a tough word even for me to say, but the idea is you're stating that based on your own facts and what you have. You know, do you have a doctor's note? Do you have some symptoms? Did you take a test? You know, there's all sorts of ways to prove you missed work because of COVID.
Yeah, which is probably unlikely, to have to do it, but just in case, I think that keeping notes is critical when you're doing something like that. But that's great. I bet a lot of our owner-operators don't know anything about that, and, that's good information for them, for sure, to understand. So, well, that's answered all the questions I had from our listeners. Did you guys have anything else you wanted to touch on?
Yeah, I'll mention, Michael, did you have anything in particular?
I just had one item. So I get this question a lot, and I don't know if you guys are thinking this as you're listening to the podcast, but I get a lot of people say, yeah, I know all that. What else can I do? I've used all my deductions. I've taken all my credits. I still owe too much. I need to take more deductions. The advice I have for those folks is, what are you doing with your retirement accounts? If you have health insurance, do you have a health savings account? If you don't, go get one. You can put $7,200 as a family into a health savings account. You keep your money and you get a tax deduction. That's a great way to get a tax deduction and save for the future. If you don't have a retirement account, go get one. You've got IRAs, SEPs, 401ks. There's tremendous savings opportunity. And when you put money into those accounts, you keep your money and you get a tax deduction.
It basically just comes off the gross, off the taxable income, right?
Yep, you got it.
Yep. Yeah, that's so good. I know there are, I want to say, I had a financial guy come on one of the podcasts with me and talk about a little bit of that stuff, but I know there's a maximum if you reach so much money, but they shouldn't run into any of that, since, if they're doing things right. But I don't know, they're making a lot of money this year, so they may run into some of those rules that, hey, you made too much money to take this off. But yeah, I didn't know about the health savings account, $7,200. That's a great help. They could put that in there, and that's for them if they have issues, I guess, have health problems, and use it.
I was going to mention real quick, Michael was talking about per diem. One thing we didn't mention, one thing we do that I don't know another accounting or tax firm in the country that does it, is we do partial days per diem, not just whole day per diem. So what's the rule on that, Michael? How do we apply it?
It's still 100%, but it's 75% of 100%. That's a tough way to do it, but 75% is $69, whatever that math is.
So the key is that we don't say you have to be away from home the entire day in order to get your per diem that day. You can do a partial day per diem. And so with that, two things I'll mention. One thing I'll mention is we have an ATBS app. For the folks that are clients know about our app. Those that don't, when I say our whole objective as a company is to make our clients' lives as simple as possible. If you get any piece of paper that you think has something to do with your business, you just send it to us and we deal with it. You can send us a 2-foot-long Walmart receipt, and you can circle what you think is deductible, but we go through it, and if we see something deductible, we take that deduction. And when I say get us every piece of paper that has something to do with your business, with our app, you literally you open up the ATBS app on your phone, you take a picture, and at that point, you never have to touch it again. It's us digitally, and you're done. So the entire extent of your bookkeeping is to open up the app, take a picture of that piece of paper, and like I said, your bookkeeping's done. You never have to. That's 100% of the extent of doing the bookkeeping for your business. Is take a picture and you're done with it. It's our system, and we do everything from there on. So you go to a truck stop and you come out with a receipt, instead of sorting and categorizing and totaling yourself and trying to figure everything out. You don't do anything. I mean, you come out of the receipt, you take a picture of it, and you're done with it. You can throw it because we've got it from that on. The other thing, the reason I brought up the app is because in our app we have a per diem tracker, so that for our clients it makes tracking per diem super simple. We don't track you by GPS for obvious reasons. Clients don't want to be tracked and don't want their per diem tracked by GPS. So we let you track per diem in our app. So when you go in the app, you just click on per diem, and you just if you've got a day out on the road or a partial day out on the road, you click whole day or partial day, and you're done. Once a day, you go in and click, and you're done for that day. And then our per diem tracker shows you what your year-to-date per diem is, how much per diem you've captured for your expense up until that current point. So it like I said, I won't get in the weeds on any of this, but it's super, super neat. The app, our clients absolutely love it. It makes their life so simple, makes per diem tracking so simple. And then the other thing you mentioned is, you said, I don't know why you wouldn't pay ATBS to do this work for you. And so I'll just mention in terms of pay, two things. First off, we give our Oakley clients a 23% discount over what we charge our typical client. And so that discount, our Oakley clients pay us roughly $23 a week to do everything everything we do. We do budgeting, we do bookkeeping, we do all of your accounting, we do monthly profit and loss statements where we benchmark you against thousands of owner-operators to show you where you're doing good or where you need to make changes to make more money. We do quarterly tax estimates. We do year-end state and federal tax returns. We do all of that work for that $23 a week. And it's the price of a couple cups of coffee a week, right? And this is the thing that's important to know. Every dime you pay us is tax deductible. So that $23 a week is a business expense for them. They don't have to pay taxes on it. And then from a tax perspective, the last thing I want to say is this is about quarterly estimated taxes. So what every tax company in the country does is what's called safe harbor taxes. And what's called safe harbor taxes, but what that means is you essentially take last year's tax bill, you divide it by 4, and then you pay that amount each quarter. And then at the end of the year, when you get to April, you look at what you paid in estimates versus what you owe, and that's when you make up the difference. We think that's the kiss of death for owner-operators because never is this year's tax bill exactly the same as last year's tax bill. So if you're paying your estimates this year based on what you did last year, and you get to April and you owe several $1,000s in taxes, I mean, you're dead. I mean, April is the worst time for an owner-operator to come up with money to pay taxes. We all have a slower fourth quarter. First quarter, business isn't as good as it is the rest of the year. We all overextend ourselves during the holidays and spend too much money on family and friends and stuff during the holidays. So we overextend ourselves during the holidays. We don't make as much money in the first quarter. If we owe a whole bunch of money, like I said, we're screwed when it comes to paying your taxes because we don't have that money saved up to pay it. So what we do at ATBS is not safe harbor. We spent literally over $1 million designing our software for estimates, and we base your estimates on exactly what our clients did each quarter, what their business actually did. So you're paying estimates based on what your business did real time, not what it did last year. There's two reasons that's important. One is because we're basing your estimates each quarter on what your business actually did, your estimates are accurate. So when you get to April, you shouldn't owe a whole bunch more money because your estimates were accurate. The second reason, and most important reason I think that our estimating process is superior, is because since we're basing your estimates on what you did that quarter, your cash flow matches what you owe in estimates. If you had a slow first quarter, it's okay because we're going to tell you don't owe anything in estimates because you had a slow first quarter. If you killed it in the second quarter, made a whole bunch of money and owe a whole bunch in estimates, it's okay because you had a great quarter and you've got the cash flow to pay a bunch in estimates. So our method matches your cash flow to what you owe in estimates, makes paying taxes super simple.
Yeah, that does make it simple when you actually take the information you already have that they're turning in. Now, can you get everybody to turn everything in? Is that a hassle for you to get these drivers to send everything to you? I'm assuming it is. That's why you made an app probably to try to make it easier. I mean, we run into the same thing a lot of times, but do y'all run into that some?
We do run into it. And so it's, the app does make it much simpler for them to get us their stuff. Like I said, our philosophy is any piece of paper you get that you think has something to do with taxes, send it to us, let us figure it out. The reason we did the app to make things so simple to get stuff to us is twofold. First off, we want that for quarterly estimates. We want it for year-end state and federal tax returns. But secondly, and more importantly, we're every day when we're getting that paper, it's being processed and building a profit and loss statement for them. And So at the end of the month, when we provide that profit and loss statement, we want that to be as accurate as it can possibly be. It'll be accurate if they send us everything. And it's critical that it's accurate because, like I said, we benchmark our clients against everybody else doing the same kind of work they're doing. And that benchmarking, I think, is why our clients average 40% higher net income than anybody that doesn't use ATBS. Is because, I mean, our clients have been with us for 3 or 4 years. They love looking at profit and loss statements and getting the details. You know, my maintenance was this much per mile, and my fifth dam insurance was this, and, you know, fuel ran this, my fuel economy was this is how much my fuel was, it's percent of revenue. They love getting in the weeds. This is my contribution margin. They love talking in all the details about their profit and loss statement. But someone who's only been with us a year or maybe 2 years, they could care less about reading a profit and loss statement. They just want to know what they need to do to make more money. So for those guys, they can open up our profit and loss statement. They don't have to look for all the details and understand how to read that profit and loss statement. We literally put green dots and red dots on that profit and loss statement. Green dot, you're doing great in this area. A red dot, you need to make a change here so you can make more money. And so every single month, if they're opening up their profit and loss statement and looking for the red dots and making changes there, they're always at best practices. They're always making as much money as they can make.
Well, I like the way you guys make it simple to do. I mean, it's a confusing task that has to be done when you're a businessman, but the simpler you guys make it, the better it is for them. And that because whether they want to or not, they're a businessman. They're owner operator. They've got to know these things, and the more they'll look into it, I mean, the more money there is on the table, you know, that they can save themselves. And got to pay attention to it when you're a business like that. And we've been doing business with you guys for years, and I can tell you this: there's very few people that we offer a settlement deduct for, you know, because, you know, you just never know about some of these businesses. We're hit up all the time about, hey, offer these to your drivers and settlement deduct it, and we just don't do it because we don't have confidence in a lot of people, but we do have confidence in ATBS and our owner operators using ATBS and offering that weekly deduction to where because it helps us in the end. Like I said in the beginning of the podcast, you know, if those guys pay attention to their numbers and they're making money, then we're making money. It's a great retention tool. It keeps them here. I mean, it's just a great deal all out. And I just encourage our owner operators to check into it. You know, because you got to be careful of the old friend from high school that does taxes, and my brother-in-law knows how to do taxes, and I get it done there cheap, and you got to be careful about that stuff because that can reach up and bite you. You miss out on this. I mean, these guys here do it every day, all day, and have thousands of clients. So I definitely encourage everybody to use ATBS. And I really appreciate you guys taking the time out of your busy day and coming on and doing this podcast with me and giving our listeners some good information about taxes, because it's here. Tax season is here, and it's got to be done. And I know you guys are putting in some long hours. So appreciate you hanging out with me, doing this podcast and coming back and doing it. I would probably expect another call this time next year, Jeff, just to update everything.
Yep. Michael said we'll be ready. Thank you for having us on again, Jeremy. We love Oakley, and we love our Oakley clients. Our Oakley clients are absolutely killing it. As I mentioned at the beginning, making $50,000 more than the average owner operator out there. And for us, it makes it really fun to do business with them because, your guys do things right, and as much as we can help them save in taxes, it's great for all of us.
I appreciate it, guys. Thanks for joining. Hey, thanks, everybody, for watching the Oakley Podcast. Comes out every Wednesday. We put out a new one. You guys be sure and check us out on YouTube. Subscribe, like, and comment, and it sure helps us out. Once again, have a great week. We appreciate it. Talk to you next week. Thanks.